We welcome at ECGS today a leading economist at the German bank Commerzbank, Bernd Weidensteiner. He is an expert on the US economy and will give us his outlook on the development of US growth, US employment, and also what that means for Europe. Bernd Weidensteiner, welcome to ECGS. Let's start with the outlook for 2014. You paint a relatively positive picture, which is pretty much in line with what we heard from Chairwoman Janet Yellen just a week ago when she testified in front of Congress. What's your view on how the US economy will evolve in the course of the year?
Well, from the second to the fourth quarter, we basically expect a 3% growth rate every quarter. The US economy started into 2014 at a relatively low pace with basically zero growth, which was due to a kind of special factors, for example, the weather. But sooner or later, the underlying growth forces should reassert themselves. We have a positive point that no longer do we expect a fiscal drag that year. Last year was dominated by the fiscal cliff discussion and the tax hikes early in the year. That will not be the case that year. The labor market is continuing to improve, maybe too slowly for the liking of some, but at least all lost jobs have now been recovered. And the US is moving along a modestly positive growth trajectory, not overly strong, which might not be too bad in the current situation since no overheating is to be feared for the time being, but also not too slow, then the labor market continues to improve. Therefore, from the time being, not too bad, I'd say.
One specific area that, of course, many economists are concerned about since the crisis erupted in 2007, 2008, is the housing markets. And recently we have seen that there is a certain cooling in the housing markets, and even the chairwoman sort of mentioned that as an area that needs to be explored and needs to be looked at in the coming months.
You are correct that the housing market disappointed in the last couple of quarters. Normally you would expect it to reset to a much higher level since the demographic situation in the US calls for a much higher building activity than it is now being the case. But the reason seems to be that mortgage rates may be reset to a higher level in the last 6 months or so. That effect should now have been worked through. Secondly, maybe banks are not yet willing to extend overly much mortgage credit to lenders. And then obviously private households burned their fingers a couple of years ago and might be more cautious in tipping their toe again into the housing market. Sooner or later we expect it to increase again. There are some positive points. The oversupply is now being worked through. Housing prices are increasing again. Mortgage rates, despite the increase, are still relatively low. And the labor market improves, which is giving the housing market maybe further tailwinds. Sooner or later it should reset to a higher level. We expect that maybe later in the year.
Do you think that the housing market still plays such a big role for domestic demand in the US as it did in previous decades, or do you think that the crisis has fundamentally changed something?
Well, currently the residential market is only roughly 2.5% of the economy. That's roughly half of the pre-crisis level. We can expect it maybe to go back to the 4% or so valuation in terms of GDP because of the demographic demand is still there. There might be some structural shift that maybe the average household size has increased somewhat over the last couple of years. Young people maybe go out of the house later than they did before, which is dampening demand. But the underlying situation is still relatively positive for the housing market. It might not be able to go back to the really good years, but it at least will go back to a higher level than it is now.
One other area that people are very concerned about in this country is looking at employment or unemployment and labor force participation. What's your view on that?
Well, on first glance, at 6.3%, the unemployment rate definitely is moving nearer to the 5.5 or so target the Fed has. Obviously, a part of the explanation is that lots and lots of people left the labor force because they don't find any gainful employment, they don't see any chances getting decent jobs, and therefore they are basically falling out of the statistics. And therefore the 6.3% definitely paints too rosy a picture of the labor market. Having said that, the labor market definitely improved. All the jobs lost have been regained. And the outlook is maybe for 200,000 plus payroll gains every month for the next 12 or 15 months, which is not too bad. And therefore some of the damage will be repaired maybe in the next couple of years, but the labor market still has some way to go.
Mm-hmm. So even that sort of fits into your picture of mild optimism. One area of concern, of course, has been since 2008 the financial sector. Do you see any signs there that there might be some frothiness in financial markets or even bubble formation?
Well, for bubbles, I think it's definitely too soon to diagnose a bubble in the financial markets on average. Obviously, the expansionary setting of monetary policy, extremely low interest rates, are pushing more and more investors in maybe more risk behavior. There seems to be a hunt for yields going on in some segments of the financial market. It is not yet maybe a very widespread phenomenon, and therefore Mrs. Yellen is maybe entitled to be relatively laid back there. But nevertheless, over the medium to longer term, if that situation with 0% interest rate continues, housing net asset valuations continue to skyrocket, sooner or later you will see some bubbles forming there, and that is definitely a longer-term risk. Nothing to lose sleep over in the next couple of quarters maybe, but a longer-term risk.
Mm-hmm. Final question, how do we link all this that you described about the state of the US economy with Europe? Europe is now slowly crawling out of a very painful recession that followed the Eurozone debt crisis. And European growth now depends on exogenous factors, basically on global demand. Part of this global demand should come from the US. Does this rosy but not too rosy picture about the US economy that you paint generate enough demand for European products? Does it actually help Europe to gain some traction with its own recovery?
Well, certainly the US will not rescue the Eurozone by way of its domestic demand. By and large, over the last couple of years, the Eurozone moved from an external deficit to a relatively high surplus, and therefore foreign trade actually played a role in the recovery of the Eurozone economies. As in every advanced economy, domestic demand is a more important side of things. There are still dampening factors there, and therefore external demand plays a larger role in the current upswing. We are mildly optimistic that it continues to provide tailwinds for Europe, but that will certainly not suffice in bringing to pass a really significant recovery. That depends on domestic factors in the Eurozone, and there still some work has to be done.
Mm-hmm. So do you see the US and Europe following each other, running on two parallel courses? Are the trajectories converging? Are we diverging? What should we expect?
Well, obviously the US train left the station much earlier than the European one, because Europe is basically trailing the US, since the crisis was much more deeper in the Eurozone, had much more intractable things there. The sheer survival of the Eurozone was in danger. That was never a question in the US, obviously. And therefore it will take longer to get a really significant upswing. And therefore the Eurozone will probably trail the US for the time being.
Thank you very much, Bernd
Thank you.
Weidensteiner.